Hi everyone, this is Sandeep. So in this video, I am answering one of the most common question out there in many people's mind about investing. The question is, how many stocks should I hold in my portfolio? Should I have 50? Should I have 30? Should I have 10, 5, 1? The question is unanswered in many places because there is no definitive answer to that question. It is really a subjective answer. But at the same time, what I'm trying to give you in this presentation is to derive at a point that there is one strategy that has repeatedly worked and created huge wealth for most of the successful investors out there. It is the process of, in this process of investing, this particular style has created wealth over and again for most of the successful investors. The purpose of being in stock markets and creating a portfolio is to create wealth. As simple as that, nothing more, nothing less. If your idea is to create wealth, you should not be looking at buying stocks like you're buying stamps. You should not become a stock collector in your portfolio. I see people having minimum 50 stocks, 75, 100, playing across all themes, right? And just like stamp collection, they have a huge portfolio. I mean, 50, 100 stocks. They won't be able to even write down those stocks without seeing once, right? In memory. So it becomes humanly impossible to analyze so many stocks. It is humanly impossible to remember so many companies, what they're doing. And that's why precisely, you see the fund managers, fund houses having so many analysts out there doing dedicated to each sector and other things. So it's not something that I would encourage people doing. So first, let me start with that point, right? I'm not saying holding 50 stocks is wrong or right, but I'm saying it is extremely complex to manage such a large portfolio, and it dilutes your earnings, it dilutes your returns. The chances of getting a stock right in your portfolio is usually probability determined, and it's usually low to medium, right? And when you really get one stock idea correct, you want to increase the impact that is created on the returns by picking that stock right. So example, if your aim is to double your portfolio every 3 to 4 years, you need to have a portfolio of high conviction stocks that can certainly double. Only if your conviction is very high that it will double certainly, it might or might not happen. But if you have, say, 50 stocks or 100 stocks, you're diluting your chances or probability, since it's difficult for so many stocks to double every 3 to 4 years. If you increase the number of chances, your probability reduces, right? So you want to get rid of that probability part as much possible and create high conviction there instead of the probability. If you think like 10 stocks, out of which 8 you're certain that they'll double in the next 3 4 years, you want to only have that. But if you have 50 stocks, you're increasing your probability aspect, you're increasing your chances and outcome, and the outcome of 50 stocks or 40 stocks out of that doubling is very less. So you want to avoid that probability factor in that and increases your conviction in that. So that is how you do it. So as simple as that, I mean, it's common sense, right? If you have 10 stocks, your chances of doubling, developing conviction in those 10 stocks that is certain to double is very high, whereas compared to the probability of 50 stocks, probability of getting 50 stocks double is way too less. Now, this is what John Keynes said about concentration and portfolio construct. He said, I'm quite incapable of having adequate knowledge of more than a very limited range of investments. Time and opportunity do not allow more. Therefore, as the investable sums increase, the size of the unit must increase. My theory of risk is that it is better to take a substantial holding of what one believes in than scatter holdings in fields where he has not the same assurance. So where you have strong conviction, where you have a strong understanding of business in your circle of competence, so what is defined by Warren Buffett, you need to have that conviction on the businesses, and you need to have a little amount of certainty that it will double in the stipulated period of time that you're going to target, for which you need to have a concentrated portfolio. When I say concentrated portfolio, not 50 stocks, not 30 stocks. We will get to that now. But this is what John Keynes, who was a very famous legendary investor in Europe, had talked about. What do other great investors say about diversification? Let's hear out from the legend itself. So Warren Buffett said this in his uh, letters to shareholders. When he acquired stake in one of the largest companies out there, like American Express. If it's your game, diversification doesn't make sense. It's crazy to put money in your 20th choice rather than your first choice. Charlie Munger and I operated mostly with 5 positions. If I were running a 50, 100, $200 million portfolio, I would have 80% in 5 positions, with 25% for the largest. In 1964, I found a position I was willing to go heavier into, up to 40%. I told investors they could pull their money out. None did. The position was American Express after the salad oil scandal. Now, so what Warren Buffett and Charlie Munger are strong proponents of concentrated investing. And what he suggests, even for a 50 million, 100 million portfolio, he would go up to, 25% holding in the largest and 5 positions around 80% of holdings. That is the level of concentration he's talking about. Now, what did Stanley Druckenmiller, the other famous billionaire investor, who said about recently in an interview, he said that I've always made big concentrated investments. I put all my eggs in one basket and wash the basket carefully. I don't believe in diversification. I don't believe that's a way to make money. You're not going to make money talking about risk adjusted returns and diversification. You got to identify the big opportunities and go for them. So you need to swing the bat fully when there is a fat pitch. That is the whole idea that Warren Buffett talks about. Now, how much diversification is adequate? Now, Seth Klarman, who's another legendary investor, author of Margin of Safety, spoke about diversification. He said the number of securities that should be owned to reduce portfolio risk into an acceptable level is not great. As few as 10 to 15 different holdings usually suffice. This is coming from the author of the Margin of Safety, who speaks about margin of safety. He thinks not more than 10 to 15 stocks is required to diversify. That is sufficient. 10 to 15 is sufficient. My view is that an investor is better off knowing a lot about a few investments than knowing only a little about each of great many holdings. One's very best ideas are likely to generate higher returns for a given level of risk than 100th or 1000th best idea. Find your balance. So what is the final takeaway in this? Find your balance. The ideal portfolio of stocks and concentration can be around 15 stocks. If you're not able to have the stomach to absorb the gyrations that market does, like Warren Buffett holding, up to 80% in 5 stocks. If you cannot do that, have 15 stocks, like Seth Klarman is suggesting, right? With not more than 10 to 15% on any individual stocks. That's like a good de-risking strategy. Beyond that, any diversification doesn't make any difference to your risk-adjusted risk management. But follow a portfolio construct that can make you sleep peacefully at night. At the same time, do not diversify to 50 stocks, which can have negative effects on your portfolio returns. It can dilute your returns. So I wanted to bring that point about concentrated investing, the importance of how much diversification is required so that it does not dilute your stock returns, but at the same time, it creates wealth for you. Thanks for staying with me. Have a great concentrated portfolio ahead. And signing off, Sandeep, Anand.